Think of the various types of investments as tools that can help you achieve your financial goals. Each broad investment type, starting from bank products to stocks and bonds, has its own general set of features, risk factors and ways in which they can be used by investors. In this video we will learn more about the various types of investments, including stocks, bonds, mutual funds and ETFs, bank products, options, annuities, retirement, saving for education, alternative and complex products, initial coin offerings and cryptocurrencies, commodity futures, security futures, and insurance. Let's start with number 1, stocks. When you invest in a stock, you become one of the owners of a corporation. Stocks represent ownership shares, also known as equity shares. Whether you make or lose money on a stock depends on the success or failure of the company, which type of stock you own, and what's going on in the stock market overall and other factors. Stocks and stock mutual funds often can be an important component of a diversified investment portfolio. Number 2, bonds. A bond is a loan an investor makes to a corporation, government, federal agency or other organization in exchange for interest payments over a specified term plus repayment of principal at the bond's maturity date. There are a wide variety of bonds including treasuries, agency bonds, corporate bonds, municipal bonds and more. Likewise, there are many types of bond mutual funds. When you invest in bonds and bond mutual funds, you face the risk that your investment might lose money, especially if you bought an individual bond and want or need to sell it before it matures. And bond mutual fund prices can fluctuate, just as stock mutual funds do. Risk will also vary depending on the type of bond you own. Number 3, mutual funds and exchange-traded funds or ETFs. Investment funds pool the money of many investors and invest according to a specific strategy. Funds come in various types, each with differing features. Generally, publicly offered funds, such as mutual funds, exchange-traded funds, closed-end funds and unit investment trusts, must be registered with the Securities and Exchange Commission, SEC, as investment companies. Private investment funds, often called hedge funds, are often exempt from registration. Funds can offer diversification and professional management, and they can feature a wide variety of investment strategies and styles. As with any security, investing in a fund involves risk, including the possibility that you may lose money. And how a fund performed in the past is not an indication of how it will perform in the future. Number 4, bank products. Banks and credit unions can provide a safe and convenient way to accumulate savings, and some banks offer services that can help you manage your money. Deposits at banks and most credit unions are federally insured up to a limit set by Congress. And transaction or checking accounts and deposit accounts offer liquidity, making it easy for you to get to your funds for any reason, from day-to-day expenses to a down payment or money for unexpected emergencies. In addition to being insured by the FDIC, checking accounts let you transfer money by check or electronic payment to a person or organization that you designate as payee. But remember, the interest you earn from bank products, including certificates of deposit, tends to be lower than potential returns from other investments. Number 5, options. Options are contracts that give the purchaser the right, but not the obligation, to buy or sell a security, such as a stock or exchange-traded fund, at a fixed price within a specific period of time. Options can help investors manage risk. But buying and selling options also involves risk, and it is possible to lose money. It pays to learn about different types of options, trading strategies and the risks involved. Number 6, annuities. An annuity is a contract between you and an insurance company in which the company promises to make periodic payments to you, starting immediately or at some future time. You buy an annuity either with a single payment or a series of payments called premiums. Some annuity contracts provide a way to save for retirement. Others can turn your savings into a stream of retirement income. Still others do both. If you use an annuity as a savings vehicle and the insurance company delays your payout to the future, you have a deferred annuity. If you use the annuity to create a source of retirement income and your payments start right away, you have an immediate annuity. The two most common types of annuities are fixed and variable. There is also a hybrid called an indexed annuity, also referred to as an equity indexed annuity or a fixed index annuity. Annuities are often products investors consider when they plan for retirement, so it pays to understand them. They also are often marketed as tax-deferred savings products. Annuities come with a variety of fees and expenses, such as surrender charges, mortality and expense risk charges and administrative fees. Annuities also can have high commissions, reaching 7% or more. Number 7. Retirement. Saving for retirement and managing income once you retire are two important aspects of personal financial management. Once you retire, the way you manage your income can mean the difference between living comfortably in retirement and running short of money down the road. Whether you are in retirement or still saving for it, there are actions you can take now to manage retirement income. Number 8. Saving for education. Education funding begins with saving. While college and other educational costs continue to rise, the good news is that there are many smart, tax-advantaged ways to save for education. Number 9. Alternative and complex products. Investment products abound that offer alternatives to conventional stock and bond investments. These products are sometimes referred to as structured products or non-conventional investments. They tend to be both more complex and more risky than traditional investments, and often tempt investors with special features and higher returns than offered by basic investments. Some examples of complex products include notes with principal protection and high-yield bonds that have lower credit ratings and higher risk of default, but offer more attractive rates of return. Complex products may use futures and options, as well as complicated trading strategies, to achieve investment objectives. Number 10. Initial coin offerings and cryptocurrencies. Digital assets like cryptocurrencies and ICOs continue to evolve and spark interest from Main Street investors. With billions of dollars raised in ICO financings and over 1,000 different cryptocurrencies currently available, these rapidly changing markets are tempting for investors. It is also difficult for most individual investors to make sense of these complex investment products and to determine the risk levels associated with them. Number 11. Commodity futures. Commodity futures contracts are agreements to buy or sell a specific quantity of a commodity at a specified price on a particular date in the future. Commodities include metals, oil, grains and animal products, as well as financial instruments and currencies. With limited exceptions, trading in futures contracts must be executed on the floor of a commodity exchange. The Commodity Futures Trading Commission, CFTC, is the federal government agency that regulates the commodity futures, commodity options, and swaps trading markets. Anyone who trades futures with the public or gives advice about futures trading must be registered with the National Futures Association, NFA, the independent regulator for anyone who trades futures with the public. Number 12. Security futures, know your risks, or risk your future. Security futures involve a high degree of risk and are not suitable for all investors. As with any investment, if you don't understand it, you shouldn't buy it. With security futures, you may lose a substantial amount of money in a very short period of time. The amount you may lose is potentially unlimited and can exceed the amount you originally deposit with your broker. This is because trading in security futures typically involves a high degree of leverage, with a relatively small amount of money controlling assets having a much greater value. Investors who are uncomfortable with this level of risk should not trade security futures. There are no security futures contracts currently listed for trading on U.S. exchanges. Number 13. Insurance. Life insurance products are often a part of an overall financial plan. They come in various forms, including term life, whole life and universal life policies. There also are variations on these, variable life insurance and variable universal life insurance, which are considered securities and must be registered with the Securities and Exchange Commission, SEC. Insurance products often are developed to meet specific objectives. For example, long-term care insurance is designed to help manage healthcare expenses as you age. As with other financial products, insurance products can be complex and come with fees, so it pays to do your homework before you buy. So, now we know about all the various types of investments including stocks, bonds, mutual funds and ETFs, bank products, options, annuities, retirement, saving for education, alternative and complex products, initial coin offerings and cryptocurrencies, commodity futures, security futures, and insurance. If this video was helpful, give it a thumbs up and subscribe to the channel. Thank you.